Hi everyone, very good afternoon and welcome back to Crack Grade B. So today we are going to start a new chapter on budgetary control and just wait for a second. Yes. So what do we mean by budgetary control? First let's understand that. See, even in our homes also, whenever we have any particular expense in our mind, we try to find out a budget for that, right? Because without a budget, you cannot proceed with any kind of expenditure. So, see, even in business enterprises also, having a budget is of the utmost importance. Why? Because budget tells you that what are your revenues, what is your expense, and this particular data is depicted, let's suppose in case of business enterprise, this is depicted monthly or quarterly or semi-annually, whatever might be the duration for it, whichever you require it, correct? So these can be the durations in it. Because see, what happens is before spending something, before spending any kind of expenditure, you need to know that, okay, what is the amount that is available with us, what is the amount we need to spend, and how we are going to manage it. So this gives you a visibility in the future that how your future is going to be look like. So this is all about budget. We are in this particular lecture, we are going to talk about different kinds of budget, different classification of budget. If I talk about with perspective of your examination, in your examination point of view, classification of budget is the most important thing. If you see the kind of MCQs that will be appearing in your exams, your MCQ classification or your budget classification becomes very important on the type of master budget, flexible budget, your fixed budget, sales budget. These are all the kinds of budget that we are going to study. Let's go to this. See, budgetary control means the literally meaning of word budget is a statement of income. It is a statement of income and expenditure of a certain period. Your CMA institute that defines a budget is a financial or the quantitative statement prepared prior to a defined period of time of the policy to be pursued during that period for the purpose of attaining a given objective. So you see, this is a quantitative type of statement which is made for a defined period of time. Next, what are the features of budget that we can do? Wait for a second. Yes. So features of budget is an analysis of the above definition reveals that following are the features of budget. A budget must be expressed in the quantitative form, that is the number of units of different products, or it may be expressed in rupees of each product, or it may be expressed in quantitative or financial form. That means the simple classification of this is that whenever you prepare a budget, it is always prepared in terms of rupees. See, we are going to do this particular chapter from very basic point of view. Why? Because sometimes we have not seen it. In the tomorrow's class, when I'll be discussing the practical part of it, I'm going to discuss this as well, that how does a budget in different kinds of format look like. So here, Any kind of budget is depicted in case of rupees or in terms of quantity, right? So these are the two things, or these are the two perspectives through which your budget is represented. Suppose I have to do the production, correct? I have to do production of 10,000 units in this particular month. So I will be making a budget that, okay, in order to produce these 10,000 units, what is the material quantity that is required, what is the labor quantity that is required, right? So these are all will be depicted in the quantitative terms, whereas some things cannot be represented in quantity values, like your overheads, your indirect expenses, that cannot be depicted in your what you can say quantitative perspective. So for that purpose, what we need to do is we have to depict that into rupees. So this is first of all the feature of budget. Next feature is it is prepared before the time for which it is required. For example, if you require the budget for 2022-23, then it must be prepared in the previous year. In every kind of big enterprises or big corporate houses, this is my experience also, that suppose coming financial year, now we are into January, and the coming financial year is 2023 and 24. So I will be preparing the budget for this, the plan for this beforehand, that okay, in the coming year what should be my sales, what should be my production, right? How I am going to spend in my salaries, what amount I am going to spend in my warehouse, or let's say sales and distribution kind of expenses. So all of these things are important whenever you are trying to make a budget, and this is made beforehand. How it is made beforehand? Suppose in the current year my production was 10,000 units, then in the next year I would like to increase it. And how will I increase it? I will see that if I have hired more employees. Hiring more employees means more production, right? If I have taken a new machinery, taking a new machinery means capital addition or capacity addition. You can produce now more quantity of your output. So hence, whenever you are making the budget for the next year, you are going to see whether any capacity appreciation has happened or not. So this is the second feature, that budget is always prepared beforehand. Next is budget must be prepared for a definite period. Obviously, you are going to prepare budget for 2 months, 3 months, 4 months, 6 months, whatever is your time period. So it is always prepared for a definite period. They must be prepared in accordance with the policies of business enterprises. Okay, if your business enterprise is following cash basis of accounting, then you will prepare as per that. If your business enterprise is following accrual basis of accounting, then you will be preparing the budget as per that, because these are the basis on which you are going to spend the amount, you are going to record the incomes into your books, right? So budgets are prepared normally for attaining organizational objectives, because policies are formulated to achieve the objectives, and those are translated into quantitative and the financial forms. Now, few of the limitations of budgeting. So budgets fail if estimates are not accurate. If your estimates, see, always your estimates should be based on your real experience plus the visibility for future. So if I am going to make the production budget for future, I will see that what I have attained in the current year. First, tell that what is your real experience. If in the current year you have produced 5,000 units, then in the next year, without significant capital expenditure, you cannot take a production of 50,000. No, that estimate is totally wrong. Why? Because this is not based on the real experience. Hence, budget estimates, sometimes it happens that your budget estimates are not accurate. And remember this particular thing, a small deviation is always acceptable. Small deviation means plus minus 2%, 3%, that is always acceptable because no one can predict future with so much accuracy. So little bit deviation is expected, but more than that is not acceptable. So that is what they are saying over here, that budgets, they mainly depend on the accuracy of the estimates. So estimates should be made on the basis of all the information available. Through forecasting is not an exact science, accurate estimates can be made by using advanced statistical techniques. The preparation of budgets involves certain amount of judgment as well as proper interpretation of the reports. So that means your real experience plus some future estimates. This is what going to tell you that how your budget looks like. Next problem which is there with the budgeting is risk of rigidity. Risk of rigidity means budgeting process creates a sense of rigidity in the minds of people. Rigidity means they tend to blindly follow whatever is given in the budget. If your employees related budget has been fixed at 1 crore, then they would not like to spend more than that even if it is giving them an additional production. So sometimes in order to follow the budget, see what happens is there are layers of workers in an organization. There is top management, middle management and then lower management. Mostly the budgeting process starts from the bottom and it goes till the top, and then finally your top management decides and seals the budget that okay, this is going to be our budget. Now once the budget is already decided, your middle management cannot change it, right? So hence for them this budget becomes a rigidity which they have to follow in any kind of circumstances. So budgeting process, they create a sense of rigidity in the minds of people who are working in the organization. But in the modern business world, which is more dynamic in nature, such rigidity will create problems. Hence, the budgeting process should be dynamic in nature. Next is, budget is an expensive process. Yes, it is going to be expensive. Why? Because believe me, in big corporates, it takes at least a period of, I am telling you, at least a period of 4 months to prepare the plan. Plan means budget, which is for the next year. So that means in every financial year, the last months starting from December, January, February and March, they go into the planning of the budget, right? So hence your human resource is busy in making plans. So your normal working, obviously it gets impacted. Your human resource is busy in making plans or the budget for the next year. So this is what they are telling you, that installation and implementation of budgeting process involves too much time and cost. Therefore, small organizations cannot afford it. See, small organizations obviously they also make the budget, but their budgets are informal, not having the detailed explanations. They just think that okay, currently we have done this, now next year we will do that. There are no proper justifications for that. But in large corporate houses, for every figure there will be a detailed explanation or a detailed working which will be followed by that. It can be adapted only if the benefits are exceeding the cost. Next is, budgeting is not a substitute for management. Yes, budgeting is only a tool for management. Obviously, at the end of the day, you have to apply your brain, your mind in order to achieve the budget. This is not should be the vice versa. Vice versa situation means budget should not be the only thing that is dictating you. Budget can only become a tool in your management process. Budget can only help you that okay, you will be deciding that what is the activity which we have to carry out. This should not be the other way around. Now moving on to the important part. Continuous monitoring is required, no explanation is needed. Now we'll be moving on to the important part in the budgetary control, that is the classification of budget. I have tried to cover every kind of budget in under that with a little bit of explanation so that you understand that how this budgeting process works. And because seeing your syllabus and seeing the contents of your questions which have been asked in the previous examinations, it is very important that you understand the names of different kind of budget, correct, plus what is the contents of them, what are the how these budgets are being prepared. This is the thing which you need to know. Now first of all, see, on the basis of time, we have bifurcated your budget into two types. One is long term budget and the other one is the short term budget. Now long term budget, we cannot define that, okay, a budget which is having a time period above than 3 years is a long term budget. I cannot say that, right? Why? Because there are so many business enterprises, and long term, the word long term differs for each of them. For some business enterprises, having a budget more than 1 year is long term. For some business enterprises, having a budget of more than 5 years is a long term budget. So there are so many variations in it. Now see long term budget. Though there is no exact definition of long term budget, yet we can say that a budget that has been prepared covering a period of more than a year can be taken as a long term budget. This is safe to say, because remember, in your accounting as well, in our accounts, what we say that any assets which is in the business enterprise for a period less than 1 year is current asset, right? And any asset which is in the business enterprise for more than a year, we call it as fixed asset. That means we consider that that particular asset is there for a longer period of time. So applying the same particular criteria over here, we have defined that we have assumed that any budget which is being prepared for more than a period of 1 year, that will be called as a long term budget. Now this particular long term budget, it may be for 3 years, 5 years, 10 years and even 20 years. It could be anything. Next is your short term budget. Short term budget which is being prepared for a period covering a year or less than a year. So these are your definitions for long term and short term budget. You don't have to do anything apart from them, right? Just understand the definition, understand the timing, for what timing the long term budget is being made, for what timing short term budget is being made, and that will be enough. Next is on the basis of nature of expenditure and receipts. So this is important because sometimes we tend to get confused in your capital and as well as the revenue thing. Although I have explained this particular thing again and again, but would like to explain it once more so that there remains no confusion. There are capital kind of expenditure as well as receipts, and then there is a revenue nature of expenditure as well as the receipts. So a normal criteria or the easiest way to define is that revenue nature of receipt and expenditures is if having no impact on assets and liabilities. And obviously the capital nature will be which is having an impact on assets and liabilities. Like for example, suppose you have got a business organization and you are paying the wages. You are paying wages to the worker. Now imagine in your mind, by paying wages to your worker, are you creating any capital asset? That means, are you creating any asset? No. Is your liability has got increased? I guess no, because this will not be depicted in my balance sheet if I'm paying this into cash, right? Has this resulted in any reduction of liabilities? I will say no. Correct? Nothing kind of. Now, the liability which I am talking about here is long-term liability. I am talking about long-term asset and long-term liability. If you are incurring the kind of expenditure, of if you are receiving a kind of receipt that is having no impact on long-term assets as well as the long-term liabilities, then I can safely classify them as revenue kind of what you can say expenditure or receipt. So like wages paid. Wages paid is not resulting in creation of any asset, long-term asset, not resulting in reduction in any kind of long-term asset, not resulting in creation of any long-term liability, not resulting in reduction of any long-term liability. Means I am seeing the impact both ways. Next is, suppose rent has been received by me. I have given what you can say a particular building in rent and I have receiving rent out of it. So again, this is having no impact on my long-term assets or my long-term liabilities. No kind of impact, neither increase nor decrease. But whenever I am talking about the capital kinds of expenditure or receipt, they always have the impact on long-term asset and liability. Long term I am talking about, like for example, suppose I have purchased a building, right? This is an expense, right? What kind of expense is this? Is this a capital expense or revenue expense? It is a capital expense. Why? Because purchasing a building is resulting into a long term asset. Hence, this will be treated as your capital item. I hope now this is clear to you. Let's move on to what is my capital budget. See, so capital budget means it is a budget which is prepared for capital receipts and expenditures such as obtaining loans. See, obtaining loans. This will be resulting into what? This will be resulting in my long-term liability. I am writing down the impacts as well so that you understand that what kind of expenditures I am telling as the capital expenditures. So whenever I will be planning for capital receipts and capital expenditures, I will be preparing capital budget. Now this is my long-term liability. Obtaining loan. Obtaining loan means loan is being received by me. So this is capital receipt. Next is issue of shares. Where do you show shares in your balance sheet? Obviously in the capital item, right? So hence issue of shares is again increasing a long-term liability for me, and this is a capital receipt because I am receiving the amount. Purchase of asset. This is increasing asset for me, long-term asset for me. This I will be calling it as capital expenditure. I hope that you are clear with it, that what is your capital budget. Next, see what is revenue budget. So a budget which is covering revenue, receipts and expenses for a certain period is called as the revenue budget. Examples are sales, other incomes, purchases, administrative expenses, all of it. Now see, doing sales, is it having any impact on my long-term assets? No. This is having an impact on my asset because my inventory will be reducing. But inventory is a current asset. It is not a long-term asset. Therefore, doing a sales, I am receiving income out of it. This will be called as revenue receipt. Other income means like your dividend, your dividend, wait, rent received, interest received, all of these are not resulting any increase or decrease in the long-term liability or long-term asset. Hence, I will call them as my revenue, receipts and expenditure, and revenue budget covers the revenue, receipts and expenses. So this is the classification of budget on the basis of type of expenditure. Next is on the basis of functions. So functional budget means these are prepared for every kind of function separately. Like what kinds of functions do we have in our business enterprise? We have production function, sales function, purchases function, we purchase the raw material, etc. Cost of production, cash function, materials function, that means you obviously you have to maintain your inventory as well, right? So these are all the functions into your business enterprise, and now we will see each one of the budgets separately. Number one in the list is your sales budget. So sales budget, obviously, I guess there is no need of explanation over here. Everyone understands that what is a sales budget. Suppose you are into the current year and you want to prepare the budget for the next year. So what you will see that, okay, in the month of July, what is the amount of sales that I have done? So in the next year, by adding the growth percentage, I should be able to do sales more than that, right? So these are your sales budget. Sales budget means sales forecast. In this particular series, I am also going to tell you that what are the features or what are the factors which you should undertake, which you should take into consideration while preparing for sales budget. See, the sales budget is a forecast of total sales expressed in terms of money or the quantity or both. Mostly this is in terms of both, because just in the value term is not good enough for me. I want to know that what should be my sales in terms of quantity as well as in terms of value. So budgets are made for both the things, not for any singular thing. I will be estimating that, okay, if in the current year I have sold 10,000 units, then in the next year I should be able to sell at least 13,000 units. Now, what should be the price of that 13,000 units? That will also be included into my budget, because this is not compulsory that whatever has been the price of my output in the current year, it is the same in the next year as well. This is not compulsory. Suppose if you are getting a bottle of cold drink in the current year for 40 rupees. So it may so happen that in the next year you will be getting the same bottle of cold drink for 45 rupees, because inflation impacts everyone and we have studied inflation, right? So this is the thing over here. First step in the preparation of sales budget is, first, do the forecast as accurately as possible. Sales anticipated during the budget period. These are usually prepared by the sales manager, who is assisted by market research personnel. Now, what are the factors that you need to consider while preparing sales budget is, see, the locality of the market. Where do you want to stay? So mostly the budgets are prepared separately for your domestic market as well as the export market. Who are your target customers? That means which industry, section or group of general public you want to sell. Product portfolio. So suppose you are manufacturing biscuits and you are having 10 varieties of biscuit. Plain biscuit, cream biscuit, cake biscuit, correct? That cookies biscuit, apart from that the glucose type of biscuit, right? So like that you are having 10 varieties. Now you have to prepare the sales budget for each and every variety. Now see how this cumbersome this process is. For every variety, whether you are going to do sales in domestic market or export market, that also you have to list. So this is why this process becomes a cumbersome process. Now the product portfolio, that is the number of products offered and their popularity among the target customer, the market share of each product and its influence on the product portfolio and the total market. So these are all the things that you need to consider. How effective is your existing marketing policy on the current sales volume and value? See, if your marketing policy is effective, then you are going to continue the same policy in the next year. But suppose if you are thinking that, okay, no, our marketing policy is not that great and we need to change it. So if you will be changing it next year, you have to take the impact on your sales budget as well. The market share of competitors product and their effect of company sales, because competition is very important. You have to see that what is your competitors next move, and you need to be prepared for that, because every move of the competitor will impact your sales. This can be seen in case of Jio Airtel very well, right? So this is the thing. Next is seasonal fluctuations. You have to consider in what kind of season your product sells the most. You have to take care of that. What is the expenditure on advertisement and its impact on sales? Suppose if currently the advertisement expenditure is 1 crore and in the next year you are thinking that you are going to spend at least 2 crore on the advertisement because of the cutthroat competition, because now you have increased your advertisement budget. This is surely going to have an impact on your sales volume as well. So prepare your sales budget by keeping this particular thing also in your mind. Now let's talk about the production budget. So the production budget is the forecast of the production for the budget period. What is the production that you are going to do? This is being prepared in physical volume as well as the cost of production. That means both in the volume terms as well as the price terms. Now what are the factors that need to be considered in the production budget? Number one is production plan. Production planning is very important for making the budget. Optimum utilization of plant capacity is taken into consideration and then your budget is made. Always remember this particular thing. Preparing budget is a function of, see, budget preparation is the function of finance department, whereas finance department will work that, okay, what should be our production budget, but the insights or the production plan needs to be taken from the production team. They are going to tell you that what is the quantity of production we have planned. That means your engineering department or production department, whatever you are going to call them. So these are the two things that we need to do. Hence, this is being told that while preparing the production budget, you need to take care of the production plan as well. Next is, what is the capacity of business concern? Capacity means what is the capacity of the machinery which is available to you. If your machinery which is available to you is having a maximum capacity of 10,000 units, then obviously you cannot plan beyond than that. You need to consider that what is your capacity of machinery that is available with you. So it is to be ensured that the capacity of the organization will coincide with the budgeted production or not. For this, plant utilization budget will also be prepared. Plant utilization budget means what is the capacity of machinery and how much you have utilized out of that. So this is called as plant utilization budget. Next is inventory policy. What is the inventory policy your business is having? See, there are so many kinds of inventory policy. One very prominent in that is just in time. Correct? If your factory or your organization follows the practice of just in time, that means you do not believe in keeping stocks of inventory. What you want to do in that is, as soon as your demand comes, you are going to call for materials and the production will happen. So this is called as just in time. So inventory levels are also going to affect your production plans. So while preparing the production budget, it is also necessary to see what materials are available. If raw materials are not available, then the production budget will be of no use for me. So for that purpose, a purchase budget or purchase plan must also be studied. On the other hand, it is also necessary to verify the extent to which inventory is to be carried. So these are all the things that impact your production plan. Apart from this, sales budget should also be considered. What you have thought of doing the sales in the current year. If you have thought that you are going to sell 20,000 units, then accordingly you need to do production as well for 20,000 units. Next is the policy of management should also be considered. See, policy of management means whether the management is okay with employing the extra personals or not. This is also management policy. If management thinks that no, we are not going to increase the wages, we are not going to hire extra employees, then your production capacity will be severely hampered and you will not be able to produce up to the level to which you want to produce. So these are the things which are should be seen from the perspective of making the production plan. Next is materials budget. Now materials budget is, see, for making every kind of finished goods, you need certain raw materials in your hand and you need to be prepared for the budget of them as well. So the materials budget includes quantity of direct material, quantities of each raw material which is needed for finished products in the budget period. The input data for this budget is obtained by applying the standard material usage rate for each type of material to the volume of output budgeted. See, if you are thinking that you are going to do the production of 15,000 units, and for each unit you are going to need 2 units of raw material, then that is how your raw material budget will be prepared. That okay, fine, we are going to need 30,000 units of raw material. So the materials budget, this depends on your production budget as well, and your production budget depends on sales budget. So this is the interlinking which happens. Next is the purchase budget. Purchase budget establishes the quantity and the value of various items of the material which should be purchased for delivery at specified point of time during the budget period. It takes into account the requirement for the entire budget plan for like sales, material, maintenance, research and development, capital budgets, etc. Purchases may be required to be made in respect of direct and indirect material. Before incorporation in the purchase budget, these purchase requirements should be suitably ascertained. Next and last is your cash budget. So this is also very important because you need to see that what is the opening you have, opening cash that you have, what is the receipts which you are estimating that you will be receiving, less what are the payments that need to be made, and finally what is the closing balance of the funds you have. So these are all the things that need to be considered while preparing for the cash budget. Cash budget is estimated receipts and expenses for a definite period, which usually are cash sales, collection from debtors, other receipts and expenses, payment to suppliers. All these things which have a cash component in it will be covered under your cash budget. Next is your master budget. So master budget, we have talked about it various times. Master budget means this includes all kinds of functional budget in it. You can call it as your budgeted P&L or budgeted balance sheet because of its nature, as it sees the impact of the total budget. So it is the budget which is prepared to cover all the functions of business organization. It can be taken as an integrated budget of business concern. That means it shows the profit and loss as well as the financial position of the business concern. Master budget is also known as the summary budget or the finalized profit plan. Please do remember these things, because sometimes in your examination, instead of asking the direct name, that is your master budget, the examiner can also ask you such kind of alternative terms for the budgets which have been used. So it combines all the budgets for a period into one harmonious units, and thus it shows the overall budgeted plans. And lastly, we have seen it n number of times. This is your budget on the basis of capacity. So this is of two types. Number one is your fixed budget and number two is your flexible budget. Now what is a fixed budget and what is a flexible budget? I should tell you the example. Fixed budget is when you say that my business is going to produce 7,000 units and you have made the budget only for 7,000 units, right? You have made the budget only by considering the quantity of 7,000 units. Now what if the actual production is 9,000? If my actual production is 9,000, I cannot compare 7,000 with 9,000, right? So this is the problem with fixed budget. Now what is your flexible budget? In flexible budgeting, flexible budget is nothing but a series of fixed budget. See, so in flexible budgeting, I will be making the budget for 6,000 units, 7,000 units, 8,000 units, 9,000 units. So I have made so many fixed budgets. That means whatever amount of production I will be achieving, I will be having a budget to compare with. That means I have made so many budgets with different quantities. So what I am saying to you, please listen to this very carefully. I am saying that flexible budget is nothing but a series of fixed budgets. Fixed budget is made just for one quantity, right? And if we have an actual production of 9,000, I cannot compare because I have not made the budget for any other quantity. But in flexible budgeting, I have made budgets for every kind of quantity, and hence whatever actual production I'll be doing, I'll be having a comparison to make, right? So this is your fixed or flexible budgeting. So fixed budget, see, this is also called as the rigid budget. Nothing to explain. When budgets are prepared for a fixed or standard volume of activity, they are called as static, rigid or fixed budgets. They do not change with the change in volume of output. These are prepared normally 3 months in advance of the year. However, these will not be much helpful in comparing the actual activity, as these are prepared at the fixed volume of output. Now, we will see flexible budget. So, a flexible budget is a budget that is prepared for different levels of activity or volume of output. If the budgets are prepared in such a way so as to change in accordance with volume of output, they are called as flexible budget. These can be prepared from fixed budgets, which are also called as revised budget. These are much helpful in comparison with the actuals because you will be able to find what are the exact deviations. The basic idea of flexible budget is that some standard of cost and expenditures should be there with you. So the budget prepared in a manner to give budgeted cost for any level of activity is known as flexible budget. When I prepared the fixed budget, I was just having a budget for 7,000 units of production. But in flexible budget, you are going to have the budget for every kind of production. If you are doing 7,000, 8,000, 9,000, 10,000 or whatever be the quantity of production. So hence flexible budgeting is done as per that. So these are the differences between your fixed as well as the flexible budgeting, right? I hope we have covered all of the types of budgets. Tomorrow we are going to solve the MCQ questions as well as the few numerical questions in order to explain that how these particular budgets are being calculated. So for today, this is it. Thank you so much for joining in, and I hope that this lecture is fruitful for you.